All right, I have got 9:59 Iowa time, and we're going to kick off here at 10 o'clock with our webinar with Marianne Bartels, who is, Marianne, what part of the world are you in today?
So I'm in New York.
New York.
So
Okay.
I'm on Eastern time.
Okay, all right. Well, I've got 10 o'clock. We've got attendees piling in. I've got a thumbs up from my technical crew. So, all right, thanks. Welcome, everybody. Excited to host this webinar today. It's something I've been looking forward to, and I've had the fortune to interact with Marianne at Sanctuary's Oasis meeting and a few other things, and then we have weekly calls. I would say that when we scheduled this, Marianne, there wasn't a whole lot going on, but since
It was quiet.
It was, since the invites have gone out and everybody's joined, well, wow, lots of things have changed. But before we get into all of that, I would love it if you would just share a little bit about you, your background, how you became part of Sanctuary Wealth, and then we'll get going with the fun stuff.
Sure. So I'm the chief investment strategist here at Sanctuary. I joined last September after retiring from Merrill Lynch after a 20-year plus career there. So in 20 years, I did a lot. I worked in the strategy department. I worked in the quantitative department. I'm well known for running the technical department for 7 years and being ranked for 6 of those years institutionally. And then I moved over to the wealth management division of Merrill Lynch and became basically the spokesperson for Merrill Lynch. Then I went back to research and launched coverage on exchange traded funds. I retired for about 2.5 years. And I ran into management of Sanctuary and they asked what I was doing. And I had actually, during my time off, educated myself in Bitcoin and the crypto space. And I had started my own consulting company and I wound up coming to Sanctuary instead of really launching that off. So I'm very happy to be here working at Sanctuary.
Great. Well, we're happy to have you, and definitely happy to have you at PrairieFire, our little part of the world. I'm still the only Iowa team, and proud of that, keeping all my competitors at bay in the state of Iowa. But an OG at Sanctuary Wealth was one of the first 20 teams that joined, and so it's been great to have you. I've learned a lot from Marianne just from the few months that she's been part of our network and circle, and so it's interesting times. Like I said, when we scheduled this, there wasn't tons of stuff going on, but there's always changes in the world. I always tell my clients we'll be talking about something different in 6 months than we are right now, and so that's definitely been the case. So a lot of my clients know this, but I started my career in banking, and here's the thing about banking is that it's supposed to be boring. It's supposed to be you bring in your deposits, you make your loans, and you focus on the spread. When I was in management meetings, that's all we talked about. How much do we have in cash? How much do we have in CDs? How much have we lent out? You know, those sort of things. It was pretty simple, and it was so boring that I decided to switch to wealth management because I wanted something more diverse. So, well, Marianne, banks are not boring at the moment. And, you know, it harkens a little bit back to the craziness of 08, but I would love to get your thoughts. So this Silicon Valley Bank that went under, a very different institution from what I'm learning, and then the domino effect that's having in the banking world. I would love your thoughts and comments and kind of where you think it goes from here.
Sure. So I had to get a quick education on how banks really work because I'm not a trained bank analyst. I'm a trained strategist. And what happened at Silicon Valley is kind of unique. They had a concentration of the type of client. And from what I've been able to assess, they did not manage their portfolio of treasuries very well, the risk part of it. After 2008 and 2009, there was a law that was enacted by Congress called Dodd-Frank. And banks have to keep very conservative investments on their balance sheet, treasuries and treasury-like securities. And the Fed has been very clear from the very beginning that they were going to raise rates. And SVB had a lot of treasuries with low yielding coupon or interest rates. So as interest rates went up, the value of the bonds went down. And my understanding is their client base, which are really in the venture capital type of market needed more cash. So there was more of a draw for capital. And what happened with SVB is that they needed cash. And to get the cash, they wound up selling a portion of their treasury portfolios at a loss. It was about 1.8 billion. And then what they had planned to do by working with Goldman Sachs was to go out into the market and raise capital in the equity market. Well, that didn't go over very well. When they announced that, there was a person that tweeted to take your money out of SVB, and you had a traditional run on the bank. So many depositors wanted their money and they couldn't fulfill it, so the government had to come in and stop it. The good news is they've guaranteed all the deposits at that bank. And not only that bank, there's another bank that we're not hearing as much about, which is called Silvergate. They actually are more in the crypto space and had elected to shut down their bank. They did not have the run on the bank, but the government also chose to go in and close that bank as well. And in traditional Wall Street, when you start having a banking crisis, they're looking for the next shoe to drop. And the next shoe that they're highlighting is First Republic Capital, and they have a bank there. That has not been resolved yet. The regulators are working on it. According to news reports, Jamie Dimon has been in working on it. But the good news is, well, let me explain what happened with First Republic. Because that was considered the next shoe to drop, depositors started moving their money out of the bank and into large banks. Large banks have the ability to cover insurance on larger deposits. And so the depositors felt more confident in moving their deposits to the bigger banks. And so their capital needs started to actually go up, but they have unrealized losses on their balance sheet. So there are about 10 banks that infused $30 billion to First Republic for a period of time as they try to work all this out. But as it stands now, we don't have a resolution. So we're kind of in this gray zone. I mean, I'm confident that this can be resolved, but it may take an act of Congress to be able to fully patch everything. And based on their previous behavior, they act. Maybe not in the most timely of fashions do they act. So I do believe that this will all get resolved, but what it will do is cause volatility in the marketplace. And we saw that yesterday based on Janet Yellen's testimony to Congress. But today we're reversing that. But one of the things that we've been communicating for a while now, as long as the Fed is raising interest rates, there's going to be volatility in all asset classes, fixed income and in equities. And that's just based on history. The other thing that we know from history is the Fed eventually raises rates until there's a problem. And now we have the problem. And now we're trying to resolve that. History also shows regulators will do what is necessary to solve the problem, not necessarily as fast as we would like, but it gets resolved. So I'm not concerned that there is an epic problem. 2008 and 2009 was a much larger problem. That was what we call a credit problem. What we have today is not a credit problem. The S&L crisis of the 80s and the 90s was a credit problem and a massive credit problem. We also saw in the 1980s a bank called Continental Illinois go under, and at the time that was the 7th largest bank in the country. We've been down roads like this before. We get them resolved, but it takes patience. And maybe not reading everything, and certainly not reading your investment statement every day, because there can be quite a bit of volatility. But what I've actually learned is when we have a crisis like this, there's an investment opportunity. What is happening is very good banks now are trading below price to book. That's the classic measure for banks, not regular equities, but banks are traditionally measured by price to book. And anytime you break below 1 times book, that is considered very good value. If you could get it at half book, it's considered like a steal. So I think investment opportunities are actually happening. But it takes time. You can be early in this process. This could take weeks, actually could take days, weeks, or months. We really don't know. What we know, because the Fed had a press conference yesterday, they raised rates 25 basis points. 3-4 weeks ago, they were expected to raise rates by 50 basis points. But because of the banking crisis, they feel that there's a tightening in the credit market right now, which is almost like saying that the industry is already tightening for them. So they elected to go 25 basis points and said that their target rate that they want to reach, which we call the terminal rate. Some people also look at it as the Fed funds, target rate. Their target has been 5.125, and that has not changed. But they did say that some or may, meaning they're going to stay data dependent. If they have the ability to raise, let's say, another 25, they plan on doing that. But if data suggests that that's not what they should be doing, then they may pause. So we're kind of in this, I would call it a soft raise in terms of interest rates, not a very hawkish, but a more dovish rate hike. And why did they raise? Because we still have inflation. Now, we believe inflation is coming down, measured by the CPI, but it doesn't come down in a straight line. So we've seen it come down, tick up. So we may get some bumpiness. Even the Fed has admitted that we can get some bumpiness. But we're raising because we want to get inflation down, or the Fed would like to get inflation down to their target of 2%. And the main tool that they have to do that is by raising rates. So did they do the right thing? They did the right thing, because at the same time that they're raising rates, they're providing liquidity to the system. So for the banks that have these unrealized losses on their balance sheet, they can go to a new facility. It's a new loan facility. And even though the value of that bond is less, they can go to this loan facility and get full value for it and put it on its balance sheet. And that is a way of stimulating. It's the Fed would make the argument that this is not quantitative easing in trying to get the back end of the yield curve interest rate down, but it is a form of printing money. And printing money is a form of stimulus into the economy. So, and it was quite large. It was over 300 billion that was taken from the window in just a matter of 1 week. So I think the Fed is trying to walk a very good balance between providing the liquidity that is needed and trying to fight inflation. And the phrase that Chair Powell used is that, our banking system is, solid, it's resilient, it has capital, and it has liquidity. In trying to ensure confidence for depositors and investors in the banking system, and that regulators will do what's needed to make sure it stays that way. Sorry, that was a very long answer.
No, it's great. You covered a lot of stuff, and we're gonna retrace a few of those topics. But that's great insight. And the thing about banks is that they bring these deposits in with the expectation that not everybody's going to want their money back right away. I mean, it's not just Silicon Valley. If every depositor went to every bank and took out all of their money, of course, it would be catastrophic, because they invest those assets. They put them out in loans or treasuries or whatever. And so that's, like you said, much, much different than 08 because of the credit difference. And so do you feel like this has a better, with this new Federal Reserve window where you can go in and redeem your treasuries at par, do you feel like that gives us a pretty good chance to not become a systemic issue?
I think, yes, I do. And I think it's about regulators talking and taking action that keeps confidence. I think this is an issue of confidence. And if they can keep the assurance of confidence that depositors will be made whole and that they don't need to panic, then we're fine with this loan facility. But if they wind up having another run on a bank, that's going to create a lack of confidence, can create some form of panic. But what I've heard Janet Yellen say, and really the Fed say, is they will deal with these issues as they arise. But they're trying to keep confidence so it doesn't happen.
Okay, great.
But I feel where we are now, the way the equity market is behaving, the way the treasury market is behaving, we have confidence that this is going to be resolved.
Great, thank you. So I say the word Federal Reserve, inflation, and higher interest rates, and I see my clients' eyes glaze over. I've been beating this drum or talking about it so much. What I'd really be interested in is, we know the Fed's raising rates to keep inflation down. They want to. We've had pesky things, though, where inflation has stayed up in certain areas, and then this crazy labor market. And so what do you think they need to see that will change this? And do you believe if we do go into a recession, they may begin to lower interest rates?
So the phrase that everybody is using is that inflation is sticky. We're seeing pockets of inflation come down and pockets of inflation really staying high. And what the Fed is trying to now tackle is wages have started to come down, but they want to make sure those wages continue to come down. When we do econometric modeling, like if you're a math person and you look for the factor that has the best explanation as to why inflation occurs, it comes from wages. So they want wages down. So how do you get wages down? You have more people unemployed. And I know that sounds terrible. And the Fed has a dual mandate: full employment and having a 2% inflation. And right now they're battling one another. They're choosing to battle with inflation because if inflation gets out of control, we have a bigger problem that we have to address. So the one item that I'm watching every week is initial jobless claims. They come out on Thursday morning, and it's a leading indicator on how many people are applying for unemployment. So I would argue they want to slow down employment, but the problem that we have is that we don't have enough people for the amount of jobs that are posted. So if you want to follow that, it's called JOLTS, G-O-L-T-S. And so we have all these jobs, not enough people, and that's also putting pressure on wages. A lot of people argue that that's a structural problem. People are aging out and their jobs are just not being filled. But even if that's the case, the Fed will continue to go after that market to ensure that inflation comes down.
Okay. So you've used the word for a while now called episodic volatility, and I think it mostly applies to your opinions on the equity or the stock market. Could you talk about that a little bit? As long as the Fed keeps raising, we expect that there would be volatility. And so, like this week alone, we see the Fed come out with some news and they parse every little word. And then there's things like these banking issues. But how long and what do you mean when you say episodic volatility, and what does that mean for kind of the future of the equity markets in your opinion?
So episodic volatility means big moves and more often. And where you normally don't expect to see episodic volatility is actually in the fixed income treasury market. And that's where we've had the most volatility recently. And what happened is, as we went into this banking crisis, rates, both on the short end and the long end, started to come down. And hedge funds were positioned for rates to go up. So they were caught what we call short and had to come in and actually buy. And we had extraordinary intraday moves. And one of the statistics that we wrote about is looking at the T-bill, the short-term T-bill moving, or 2-year, excuse me, the 2-year, was on the 2-year treasury note, moving more than 50 basis points in one day. That happened 4 times in history, once in 1987 and 3 times right after the banking crisis. To give you a sense of the dramatic intraday moves, that's episodic volatility. So with the Fed raising rates, with a banking crisis, and this being what we call a fluid situation and news constantly evolving and changing, you get these rapid moves intraday and on the day. And as for you asked me about the direction of interest rates, the Fed is expected to raise rates one more time, or at least they want to. The market is forecasting that the Fed will cut rates sometime this year, because now, because of the banking crisis, we're starting to factor in that a recession is closer. I know this is the most predicted recession in the history of markets. But the market is now saying, with a credit tightening because of the banking crisis, we're closer to a recession. An indicator that we watch is called the Treasury yield curve, which is the spread between the 2-year Treasury and the 10-year. That had been inverted, meaning the 10-year is below the 2-year, but then started what we call steepening. History shows when that happens, you're closer to the recession. And so the market now is moving and starting to price for a recession. Personally, I believe the Fed will try to keep rates up and as high as they possibly can until they have a signal that inflation is moving close to their 2% target. So I would anticipate rates to stay higher for longer unless the market needs lower rates or the economic data changes in such a way that they feel comfortable lowering rates. So it's going to be really a tug of war between the markets and the Fed, because we've been through this cycle where the market looks for the Fed to lower rates, only for the Fed to say, hey guys, we're not doing that. And then they reprice, and then they reprice again, rates going down, for the Fed to come back and say, no, we're not. I would see the press conference yesterday softened that a little bit and opened up a window to a pause, not a rate cut.
Okay, so maybe, because I was looking at the pattern of rate increases, you know, they went 25, 25, then 75s ran, and it's almost like a bell curve. We're back to these 25 basis point increases. And so it seems like we're closer to the end of all of this than we are certainly nowhere near the beginning of it. But it's just gonna, as they keep using the word data dependent, and you agree, that's what they're watching.
Dependent.
Okay.
They're data dependent. And now what they're really going to be watching is that this credit tightening that they anticipate from this banking crisis, how that's going to affect the data. And what Powell said in the press conference yesterday, they don't know. They anticipate it, but they don't know how it's going to impact, and they will be watching that. So they are more data dependent now than they were before.
Gotcha. Okay. You know, early in the years, I read everybody's forecast from Goldman Sachs to Morgan Stanley to Merrill to ours. Everybody was incredibly pessimistic, and I put in my insights piece that I had never seen so much pessimism as to what was going on in the market. Well, I feel from you, and I've sensed from you over the last few weeks, a relatively, we use the word bullish to say we think the markets are going to go up, a relatively bullish posture. Do you still feel that way, and why do you feel that way?
I'm bullish for the long term. I honestly believe that we're in a long-term secular bull market. So what does a secular bull market mean? You will always have bear markets in a secular bull market, but in a secular bull market, you go down and you come back and recover and can achieve record all-time new highs. When you're a secular bear market, you don't have the ability to do that, and you stay in a trading range. In a secular bull, you trend up. So we believe that this pullback that we've been in is a buying opportunity. The question is, we had a low in October, and originally I thought that low would have to get tested. Prior to the banking crisis, things started to improve, and I really started to see the behavior of the market improve, particularly in cyclicals. And what we were seeing is that the recession was getting pushed out, because the service part of the economy and the consumer is so strong. It looked like we would have the ability to actually rally. Now, this banking crisis does alter things. So the word that I'm using now is to have a more balanced portfolio. I would have a little bit of dry powder in there. You know, we've liked fixed income since rates have gone up. We've said that 60-40 is back. When you can get paper at 5%, after having 0 for 14 years, that's a tremendous opportunity. So I think clients really should be thinking about a more balanced portfolio. We also call it barbell, right? Have that equity component, which is higher beta, have treasuries, which are lower beta. And I understand last year was a very unique environment where stocks and bonds went down. But getting out of the zero interest rate environment, we were going to have pain no matter what we did. When rates went up, it was going to be pain in the fixed income market. I feel we've had that pain. Now, with that said, if we do go into a recession, I anticipate rates coming down. So rates right now, both on the long end and the short end, are very oversold. If we get a backup in rates where rates go up, I think these are great opportunities for clients in their portfolios, because I don't think we're going to see those rates for a while. I think rates are going to go down. I'm on record and I'm staying with that 10-year treasury yields can go down to 2.5%, especially if we go into a recession. But I think once we get there, we're going to have to rethink how we position fixed income portfolios, because I believe there's a regime change happening in the fixed income market. We're going to have a more inflationary economy than what we're used to. This stems from all the stimulus from the Fed. It also stems from all of the fiscal bills that Biden has passed, the CHIPS Act, the Inflation Protection Act, the infrastructure bill. That's all stimulus in the economy. We're also doing what we're calling reshoring back to the United States and nearshoring, meaning we're moving away from China and not being as manufacturing dependent on China. That's inflationary. So we're going to have a bias in the economy over time where there's going to be some inflation. So how we manage bond portfolios will go back probably to ways that we similarly did that in the 70s, where we have to do a lot of laddering within the portfolio. But I do think that they provide good diversification. Right now, they're providing very good income. As for the equity market, I think you do a barbelled approach there. You take on some cyclical exposure, and then you take on some defense exposure. So I think they're hitting the commodity market because of the anticipated recession. I think commodities are in a longer term bull market, especially if we're going to be in this inflationary environment. But right now, that materials, energy are not going to perform as well. But industrials, because of all of this reshoring and nearshoring, that's going to be positive. Aerospace and defense will be positive. Whenever you're in war and there's a lot of spending on war, you own defense companies. The United States has committed $113 billion to that industry, worldwide $2 billion, and we'll probably have to do a restock. So that group in there, I think, has a positive wind behind its wings. In terms of defense, normally when rates go up, utilities don't do well. And that's just competition for yield. But the utility space is actually quite depressed right now. I might be looking for some utilities because in terms of our energy distribution, we're going more and more electric. We're going to be investing in the electric grid. So I think you can add a little bit more utilities. Healthcare is down a lot. And I think you can diversify into healthcare. And if you have all of that, it's about sitting there and being patient.
It's hard to do.
The other area of cyclicals that I do like technology. Longer term, we're in a new digital world. The new infrastructure, the new fabric of our economy is going to be investment in technology. Right now, the buzzword is artificial intelligence, AI. Everybody's talking about chat GPT in terms of artificial intelligence. All technology needs a semiconductor chip, a brain. And I think that's a pocket that will stay in demand for a long time. The pockets I'm a little bit more concerned about are the mega cap names because they become so large in the index. In fact, in the Wall Street Journal today, they talk about how Apple and Microsoft alone are at the highest weight ever in the history of the index. Normally, that's not a good sign. Doesn't mean that these are not good companies. It just means that everybody is concentrated in these names. So I'm looking for ways to diversify. I like semis, and the other pocket that I would look at is software.
Great. Yeah, you say regime change. It's definitely a new economy, and
Bluetooth connected.
Sorry. Many times the indexes in the past, were heavily weighted in things like energy, and now the top of SPY and these index funds that we use are so heavily weighted in tech that when you have that kind of recession that they have, it gets challenging. And so it seems like with higher rates, it seems like with so much federal intervention, the United States equity market has fundamentally changed over the last 10 years, and I'm sure it will change fundamentally in the next 10. But we're both fans of Richard Bernstein and some others that have said perhaps it's time to look outside the borders of the United States for investment opportunities. What's your opinion there?
100% agree. When we look at the S&P 500 relative to the rest of the world, we've had a technical breakdown. The US has been a leader for many, many years. And now what we're starting to see is that we're losing part of that leadership. What's really good about that is the valuations outside of the United States are much cheaper. So we think this is a very good time to diversify outside of the United States. Also, if rates are going to come down, it means that the dollar will have a hard time going up, right? Because you have a currency component. And if your currency keeps going up and you're invested outside of the States, you can lose part of the return. But if the currency is stable to maybe drifting a little bit lower, it actually adds to the return. So I think that this is one time that you can diversify outside of the United States. I would say that it's a cycle. There are times you want to be outside of the United States. There are times you don't want to be outside of the United States. Now I think is an opportunity to diversify fundamentally outside of the United States.
Okay, great. I've got a couple more for Marianne. I want to be conscious of her time. You all have a question box on your system there. If you have questions you want to submit, please do that in the Q&A versus the chat so I can keep track of that there. You have developed an expertise during your semi-retirement around cryptocurrency, and no one's talking about it right now because it's been so decimated, and I had lots of questions about it when it was riding high. But where do you think that fits in like the next 10 years when we talk about regime change, new economy? Where do you see that, what I feel is the kind of a Wild West, but like the internet was in 01, it had legs and became something. So what's your opinion there, and where and when do you think investors should consider getting involved?
That was a great analogy that you used. Wild West in the early 2000 or late 90s, early 2000, but eventually had legs. And I think the crypto space is very misunderstood. And it does have legs. Really, from a technological standpoint, the blockchain is the next generation of the internet. We're going to move everything on chain. And that's because it validates every transaction and it's recorded. But let me kind of explain what Bitcoin is. Is Bitcoin a currency? Yes, Bitcoin is a currency. Is it backed by anything? No, it's not backed by a government, and it's not backed by an asset. What the internet was missing was a form of electronic cash. And I believe Bitcoin will be a player in terms of an electronic form of cash, not payment, but of cash. Bitcoin was designed to actually be scarce, similar to gold. We can only create 21 million Bitcoin. And Bitcoin are created by the miners. And the miners are the computer programmers that are authenticating and creating Bitcoin on chain. So Bitcoin is real. I think it stays around. I believe the SEC has validated Bitcoin by allowing a future on it. So I believe that the government has already told you Bitcoin is here and it's not leaving. The next largest coin is called Ethereum. Some people call it Ether. That is not a currency. It is a software program on the blockchain. So it's very, very different. So if you can go back, if you can remember the first time you had email, the first program on the internet, it was just the internet and email. Could you tell the difference between email and the internet? Probably not. But as we developed more software programs to put on the internet, you became aware that there were these different programs that sat on the internet. Ethereum is that program that's being built on the blockchain that most programmers are choosing to use. So it's not exactly the same example, but think about a Microsoft and what Microsoft provided. And most people adopted it, and it stayed as a primary program on most computers. That's what Ethereum is trying to achieve, but we don't know if that's really going to happen. So if you go back to the late 90s, early 2000s, we didn't know who the winners and the losers were. We're really there. It is the Wild Wild West. Everybody's competing to win on that chain. Once, even with Ethereum, if that's the program, there's what we call smart contracts that will trade on Ethereum, or a competitive software package. And this is so early, we don't know the winners and the losers, and we call them cryptocurrencies. So I think that creates a lot of confusion because they use cryptocurrencies. They also call them tokens, so we think they're money. They're not money. Really, it was a brilliant strategy to raise capital and not have to list on the New York Stock Exchange or NASDAQ and have to go through all the regs of the SEC. They bypassed all of that. And I think that's why Gary Gensler is trying to say that some of these cryptocurrencies are securities. But he needs Congress to give him the powers to be able to regulate it. So we need regulation in the space because there's a lot of gray areas. And but this is not going away. This is a new level of technology. And we're going to be launching a podcast next week. I interviewed Jenny Johnson, the CEO of Franklin Templeton, and we did have a conversation about the blockchain. And I even asked her, will we see stocks on the blockchain someday? And she said, yeah, we will see securities go on the blockchain. This is just a whole new evolution of technology. And it's challenging because there's new words, there's new terminology that we have to learn. It can be intimidating. You know, when I first started, studying crypto, I had to learn about what's a hot wallet, what's a cold wallet. Transaction fees are called gas. And I'm like,
mining.
Gas or
There's mining, but there's no mines.
Exactly. So the terminology, I'm like, why did they have to change it? But anyway, it's its own world of technology. But I went to a conference last year, and there is a movement. There is a very strong movement in this space. And where you really see it is in the younger generation. This is really a younger generation movement. And really their goal is to really have less control of what they do. And I'll give you an example. If you want to wire money to Europe, it can take a few days. In fact, many people joke that you can take a suitcase of money and get it faster to Europe than you can a wire. Well, when you're on chain, it's instantaneous. They want to be able to move and do things at their speed, not what the bank tells them. Mm-hmm. Right. And so we're going to wind up seeing this all evolve and all change. And I actually find this absolutely fascinating. But what I need to say, in all my years, and I've been doing this about 40 years now, the asset class of like Bitcoin and Ethereum, the crypto space, is the most volatile asset class I have ever experienced in my life. It goes up and down 80 to 100%. This is not for, and you have to be a risk taker. You have to be willing to lose all your money. This is a really, it's not for the faint of heart. But with that said, what I found fascinating during the banking crisis is Bitcoin has been trading in a range for a period of time. But as this crisis evolved, gold is going up. Gold is being used as safety, but Bitcoin also started to move. So there is, I believe, a community of, I'll just call them investors, that are choosing to actually put their money in Bitcoin, I think for safety. Now, I can't guarantee that that will be safety, but I believe that behavior is showing that they're choosing to go into Bitcoin for safety.
Yep. Well, any scarce asset to me is always interesting. If there's only so much of something, there's probably an investment case to be made. But you think back to, eToys versus Amazon and who came out of that. You didn't have to be first to do well with Amazon as a company. I mean, if you
Correct.
invested in it in 2011 or 12, 10 years after it really, began selling things more than books, you've done very, very well. So that fear of missing out is probably not something to engage with crypto until some of these things work out. Would you agree? Or
I would agree with that. But what the industry did do, which was, in my opinion, revolutionary, if you want to go out and you want to buy a high price stock, let's say a stock that's trading $1,000, you have to have $1,000 to buy it. In crypto, you don't. You can buy fractional shares. So if you want to buy $1 of Bitcoin, you can buy $1 of Bitcoin. Mm-hmm. And I think that's what's revolutionary. You don't have to take a very big, right now, Bitcoin, the last I saw it was at least $25,000. You don't have to have $25,000 to buy Bitcoin. You can $1, $10. So there's a way of managing risk and getting exposure that we didn't have during the internet.
Gotcha, that makes sense. Yeah, so ways to participate a little bit without getting over your skis as far as your allocation goes, and seeing where this shakes out, because it sounds like there's a promising future. We just don't know who will be participating in that or not.
Exactly. And you want to talk about episodic volatility? Episodic volatility on steroids.
Yeah, not everybody likes that. Some investors dig it, most don't. The fear of loss greater than the enjoyment of gains. So, well, I'm looking here. I don't see any questions coming in. I want to be conscious of your time, and I'm so grateful that you've taken the time to meet with PrairieFire today and share with my client family your thoughts. And they've heard some of your words come out of my mouth, so now they'll know where I'm learning some of this information and one of the sources that I'm using. But any closing comments, things to think about as we move through the rest of the summer here? Hopefully it'll be summer.
Yeah, when you're in a bear market, because we don't know where this is going. We don't know where the banking crisis is going, although I have confidence that they will fix it. We don't know if we're having a recession really. We think we are. How deep it will be, there's an argument between soft or hard. Stocks will have to price in events. As much as I believe we can hold the October lows, if we start breaking those lows, it's not going to feel good. And the one thing I learned is when you go down, it's on bad news, not good news. And I don't want people to panic, right? It's about looking at your long-term goals. It's about really now making sure you have the right asset allocation to achieve those goals. Maybe tweaking a portfolio a little bit, but to have patience and ride out the volatility and have dry powder, because, as I said, some of the banks I think are great values, maybe even better values in a week or a month from now. That possibly could happen. It's patience and knowing how to be nimble in a portfolio. Great.
No, that's super advice. And again, very much appreciated, Marianne, you joining us today from New York City.
Yeah, absolutely, my pleasure. Thank you for having me.
You bet, you bet. Thank you all, PrairieFire, for joining us today. We'll be back in touch soon. If you're around on April 6th, we're having an open house to celebrate our new office. So we hope you'll join us that evening. And we'll have Masters themed foods and drinks because the Masters starts that day. So, all right. Marianne, thank you again so much. I hope everybody has a great rest of your week, and we'll talk to everybody soon. Thanks.
Bye-bye.
Bye-bye.